Some think this young woman's small tailor shop only works with cloth and thread. Little do they know, something greater is quietly being pieced together.
Thank you. Kongsi, kongsi. Bye-bye.
Girls, let's pack.
Boss, actually there's another job.
What? How can we finish it in time? Who is it for?
Oh, my best friend.
Boleh je. You go now and enjoy your reunion dinner. Go.
Go. You can come back tomorrow.
Silap-silap kita ni orang yang last kali rushing for Chinese New Year.
At least you got salary and job, ma. No complaint, lor.
Less talking. Faster finish this lah. And don't forget, once this is done, we still need a design that can represent all of us, you know. We can make it, right? It's Chinese New Year, you know. This is so heavy and muddy. Why do you always pick the lotus?
I remember when I was a young girl, my mom told me that the lotus is a lot like women. Kaini, Maru, Amay.
Bos, ingat tak masa tu? Ada tak mampu nak bayar rental rumah. Tapi you datang.
Why don't you come work with me?
You showed me how to live with dignity.
I telah cakap berapa kali, kerja diam tak boleh bawa anak, Ma.
You can speak up for yourself.
There was a time I honestly didn't know how to continue living. It was you. You told me everything was going to be all right.
It'll be okay. Come, follow me.
And that has carried me until today.
We made it for you, the lotus. Because it was you who told us that the lotus
Doesn't choose easy water to grow in.
Even when it grows from mud,
It keeps its beauty, untouched by what tries to hold it down.
It is you that reminded us, no matter how difficult things become, you don't lose who you are.
Thank you, everyone. In the end, the greatest wealth is knowing our true worth.
And that is the story of this young woman's small tailor shop that has been quietly helping hundreds of women piece their lives together again.
Hi, good morning, everyone. Welcome back to Money Kappa at 8. Aiman here. Okay, so the S&P 500 will finish slightly higher on Monday session, edging by 0.04% to close at 6,881.63 points higher after a volatile seesaw session, right? So the market staged a remarkable recovery. The sharp early morning drop from 1.2%, reaching the 6,800 points. However, the index, rebounded as strong gains in the big tech like the Nvidia and also the some of the energy stocks offset the initial panic caused by the war conflict. So yeah, I think we expect a cautious and also a headline-driven opening into today's session, Tuesday session, right? As investors remains on edge over potential retaliation in the Middle East and the impact of surging oil prices on inflation, right? So if you look at the China A50 futures, so it finished slightly higher on Monday, staging a surprise rebound against a massive global sell-off triggered by the war conflict. So yeah, the market recovered as investors heavily bet on the state-backed market intervention together with the anticipated major economic announcement at Beijing's upcoming two-session parliamentary meeting this week. Also, for those who trade if China A50 futures, I mean, you can expect a highly volatile but sportive Tuesday's session as the traders balance this strong domestic rescue hopes against the ongoing geopolitical panic. So I think the 14,700 zone is crucial. I think the price now is hovering at the 200-day moving average, and if the bullish follow through, this might rebound higher to climb towards the 15,000 psychological level, right? So if you look at the WTI crude oil futures, were surged on Monday, gaining over 5%, 5% to settle near $71 per barrel, following the massive 10% jump earlier. So yeah, I mean, everyone knows price skyrocketed as the market reacted over the war premium and also the subsequent effective closure of the Strait of Hormuz, which if you guys remember, this handles 20% of the global oil movement, right? So I think with that, we expect an extremely volatile session for today as traders weigh the risks of prolonged blockade against a potential release from the strategic oil reserve. So if you look at the charts right now, following the recent breakout, we shift our resistance higher to $77 level and also $82 level resistance, with our support now remains strong at $70 level. So I mean, as we hold our positive trading bias unchanged, we keep our stop loss intact at $65 level. Also, if you look here, the commodity is now trading above all of the moving average, giving support to the oil price, right? So looking at our market, well, the KLCI together with the FKLI futures finished lower on Monday session, with the benchmark index dropping roughly around 0.9696% to close at 1,700 points. So the market faced a widespread regional sell-off as the escalating war conflict in the Middle East war conflict wiped out the global risk appetite. Though strong buying in the energy and also the material stocks fueled by the surging oil prices helped to cushion some of the broader uh, uh, broader fall, right? So yeah, I think expect highly cautious and also volatile movement into this session as investors continue to defensively rotate capital out of the tech and also consumer stock into safer um, commodity linked asset. So if you look at the FKLI, right, for those trading FKLI, well, yesterday it has breached below our stop loss at 1690 points level, and with that we shift our positive trading bias to negative trading bias. Now we are aiming for the 1660 points level if the bullish momentum follows through, and our stop loss now is seen at 1750 level. Well, yeah, I think it was cautious that the month for the KLCI, well, it fell 0.96%, right? To close just below the psychological um, I mean, towards the 1,700 level. So I think the broad base retreat following the global shift into the risk-off mode was due to the renewed, conflict in the Middle East, which hit our tech and consumer sector quite hard. So I think despite the red on the board here, we saw some significant rotation into commodities. You see here, petchem and also hibiscus both posted solid gains as energy price climb. So I think on the active list, right? Zetrix and also Velasco saw heavy trading volume yesterday, though the overall market breadth remained fragile with over 1,000 decliners. So yeah, I think moving forward, we expect the market to stay sensitive to the overall or the regional, the international development. So keep an eye on the energy related play, which might offer some protection against further volatility. Right. So looking at the sector movement, again, the war as the war premium heightened, the energy sector continue to be the eye on of the investor, gaining over 3% yesterday. So this is our watch list, and in terms of our trading stocks, our Malaysia trading stocks, so we have Mega Fortress, right? It's not Mega First, but it's Mega Fortress today. So the stock is on its pending breakout formation, higher at 98 cent level on a strong volume. So with that, we expect the momentum to keep bullish and stock able to propel higher to test the next resistance at 103 cent, followed by 108 cent level. So if the stock to clear below 93 cent support, this could reverse the trend and trend lower. Right. Also, we have Vasco. So the stock is experiencing a pending breakout as well. We're going to get a 5 cent level. So if the stock remains bullish, we expect the price to reach 112 cent in the coming session, together with high volume as well. Second resistance is at 119 cent level. Also keep an eye at the 98 cent support for any attempt of reversal. And for the FCPO, rebounded significantly on Monday with the benchmark May delivery contract surging somewhere around 105 ringgit per ton to close at 4147. So yeah, the market rallied as the massive jump in the global crude oil prices, which triggered by the retail Iranian strikes in the Middle East, which made the palm oil a much more attractive feedstock for biodiesel. So I think, yeah, we expect the bullish, not bullish, but more on the consolidation opening for Tuesday session, as prices are likely to remain supported above the 4,100 mark, with traders closely watching for further supply disruption in the Strait of Hormuz. Right. Okay. So for our promotional campaign that we have currently, so here you can now stand a chance to win a Tesla, and also iPhone 17 if you trade with us. The more you trade, the higher ticket of winning for you will get, right? So yeah, I'll stop here and pass to Alex. Thanks everyone, and happy trading.
Hi, morning, folks. Thanks for taking the time to dial into Morning Kappa at 8. I hope you can see my screen. Let me just quickly take you through the recently concluded December 2025 quarter earnings review before we talk about how the market direction is likely to pan out, and what the key drivers of investor attention should be. Now, I think the corporate Malaysia's looks to have emerged from the reporting season in pretty decent shape. 62.3% of the fourth quarter results were in line with the growth forecasts, and with expectations, and this was record high. 14.6% of earnings beat, 23% missed, and I think we did see just one sector, the gaming sector, disappointing, whereas three sectors beat expectations: construction, healthcare, and property. Overall, we did see nominal earnings revisions for the RHB stock coverage. There was a modest plus 0.1% for 2025, coupled with a 0.8% cut for 2026. And this was largely attributed to what we see as an outlier, which was the significant earnings miss at Petronas Chemicals that plunged into a net loss for the year 2025 compared to our small forecast for a small profit for the year. And therefore, the net loss resulted in a material negative adjustment of 583 million for 2025 and 1.2 billion cut for 2026. So if you actually strip out the negative earnings revisions at PChem, market earnings would have seen a positive 0.8% revision for 2025 and a positive 0.5% for 2026. Excluding PChem, I think the complexion of the rest of the reporting was pretty decent. Misses to beats ratio relatively stable at 1.6 from 1.4 in the preceding quarter. And there was other smaller negative adjustments to 2026 forecasts coming from plantations, tech, energy, and telecom. But this was offset by positive revisions to earnings from auto, banks, non-bank financials, property, and basic materials. For the large caps, again, a pretty similar story. We excluding PChem, large cap earnings would have seen no material adjustment for 2025, and a small 0.3% increase for 2026. So overall, when we see the complexion of guidance from managements pretty much across the board, I think generally there is a sense of optimism on the potential prospects for business and growth environment through 2026. And as such, really the fundamental 2026 outlook, does support our base case constructive view on equities on the back of a positive house macro view, expectations for more rate cuts, a softer dollar, robust liquidity conditions, the domestic growth initiatives, and Malaysia's relative political and economic stability, and commitment to reform, especially when compared to our other regional emerging market peers. But of course, as you've heard from Aiman earlier, I think all eyes are on the events in the Middle East, and the ongoing Middle East turmoil has turned investor sentiment into a more of a risk-off mode. I think the surprise attacks in the Middle East, on Iran, I think did catch the market by surprise, and therefore yesterday's knee-jerk sell-off at the beginning was really no surprise, as investors started taking some chips off the table. But we did see, as the day progressed, we did see some bottom fishing coming back through, and the market obviously throughout the day closed off highs, although we did see a big lick down overall for the whole day. And I think really the base case right now, and is that the ongoing Middle East conflict doesn't evolve and spiral into a very long, drawn-out kind of conflict. And if you look at the events from last year, there was a 12-day conflict between U.S., Israel, and Iran in 2025, when the U.S. bombed the nuclear enrichment facilities belonging to Iran. And hopefully, what we are seeing now is something that does not spiral into a long, drawn-out war. And of course, if we do see events escalating, if it does end up with U.S. troops being committed onto the ground, then that would clearly be a major negative. I think so. The base case is for a relatively short conflict, and especially considering that the U.S. public has no inclination for any kind of long, drawn-out foreign war, and therefore, on this basis, we would definitely look at major, gap down, any kind of potential gap down events as a potential opportunity to start nibbling on such events. But of course, one needs to be very cautious, given that it's almost impossible to predict how the geopolitical cookie is going to crumble going forward. And I think right now, we do hope that an extended conflict does not evolve into that situation, nor the weaponization of oil. That obviously will have a major global inflationary implications the longer this goes on for. Okay, so overall, we did not change any of the sector weightings, and we remain overweight on banks, energy, consumer, property, healthcare, basic materials, construction, and REITs and technology. And right now, if you look at figure 16 on the report, when you get a hold of it, we do still, our earnings growth forecasts remain intact for 2026 and 2027. And with the markets at around 1,700 points, it does put the forward Ps at about 14.8 times, slightly below the long-term mean of 15 times. Okay, I think that's it from me. Let me just pass the time to the next presenter.
Thank you, Alex. Hi, good morning, everyone. We have a company update on IHH. This is a downgrade report to neutral from buy, with a slightly lower 9.41 ringgit target price from 9.52 ringgit previously. This is a post analyst briefing update I think they have unveiled their 2030 strategy, while the target of adding 4,000 beds actually remains. The timeline for this has been again extended to 2030, following the pivot towards daycare model, which actually helps free up inpatient bed capacity. The expansion, this 4,000 bed expansion, will prioritize brownfield developments in markets with structural bed shortages, particularly in India as well as Malaysia. And although the expansion continues in hospitals with occupancy rates above 80%, the emphasis in Malaysia will be on secondary hospitals, right? So no specific capex guidance was provided, but management indicated expansions will be funded internally and are expected to be ROE accretive, given the brownfield nature of the expansion. In terms of some of the targets as well as operational updates, the stabilization of Mount Elizabeth Orchard, which is in Singapore, that has been pushed back to second half of 26. If you were to recall, we saw weaker than expected numbers for Singapore in fourth quarter. This was because of this. Singapore EBITDA margins were also affected by the newly opened 200-bed transitional care facility. And meanwhile, the group actually is targeting to introduce more treatment packages to compete with the public class A wards in Singapore. This is the top tier of the public wards in Singaporean hospitals. Though we view that this may perhaps moderate the inpatient revenue intensity. Meanwhile, in India, the weaker EBITDA margins recorded in fourth quarter were due to one-off expenses relating to labor code, as well as property revaluation. And excluding this, we calculated that the margins would be slightly closer to 20%. Malaysia-wise, it remains a bright spot. EBITDA margins in fourth quarter is high at 29%. But we do believe that this number would again normalize back to the usual mid 20% range, likely potentially coming from wage hikes as well as supply renegotiations. Meanwhile, the growth momentum in Turkey as well as Europe, that is expected to remain intact. In terms of earnings revision, we are raising our 2025 to 27 earnings by 1%, 3%, and 5%. This is after updating our key assumptions. The EBITDA margin forecast remains within management's 22 to 24% guidance, but we are towards the lower end. For 2026 wise, we continue to expect the low to mid teens constant currency growth in revenue and EBITDA. And despite these upgrades in earnings, revisions to our SOP assumptions resulted in a lower 9.41 TP, which implies a 16.4 times FY26 EV to EBITDA, or at two standard deviation from its 5-year mean. We continue to view IHH as a high quality defensive care, but we think the current share price actually leaves little room for error. Our downgrade reflects a wait-and-see approach as we anticipated, slower Singapore recovery, as well as normalization in Malaysian margins. And in terms of the strategy, we think it's sound, with daycare transition aimed at improving capital efficiency, and expansion plans expected to be ROE accretive. That's all from me. I believe I'm the last presenter for today. Thank you all for joining. See you again same time at Morning Kappa at 8. Thank you.